What's up guys, Jake here. Welcome back to the channel. In today's video, we're going to do another update to my brokerage account challenge. In the event you haven't seen any of my prior videos, I will include the playlist down below so you can catch up. And it is me versus a total stock market index fund. My goal is to double my account balance of $25,000 from January 1st to December 31st. At the very least, I have to outperform that total stock market index fund. My positions in this video are current as of February 24th. This is trading day 36 of 252 for the year. And the stock market, there's been some downswings this week. It always happens, well, not always, but the trend has been market open, there's a sell-off, and then during the day, people start buying. Market opens, sell-off, then during the day, people start buying. So it's like it's like, once again, there's people with money who are still looking to invest. So everybody is looking for any opportunity for a dip to put more money into the market. But the market has been volatile and we're still not back at all-time highs. The index fund is up 7.08% or $1.77, and I am up 10%. So I am up $2,547.30 since I started this year. This is what my account balances positions look like as of February 22nd, if you want to pause the video. And it has changed to this. So we're going to explain what's changing with my account layout and strategy. But as far as individual stocks, I am only in 7 at the moment. So I'm sitting on over $6,000 worth of cash. I'm expecting more volatility in the market, especially the next month, as we approach the 1-year anniversary of the bottom from the pandemic last year. However, this is what all my options positions look like now, and this looks like a lot. I'm sure if you've never bought or sold an option before, this is going to be very intimidating. However, we're going to go through each one so I can catch you up with what I'm doing here. In the last couple days, I sold out of 2 positions. I sold out of Verizon and AT&T only for a $26 profit and $4 profit. The reason why is I purchased call contracts. Call contracts give me the right to purchase this stock in the future if the price goes up. So with my 2 call contracts, I'm already controlling 100 shares each of Verizon and AT&T. So there's no reason for me to actually be owning the stock now, since once again, I've reserved the right to purchase it in the future for a favorable price. If you want to see my Excel spreadsheet, this is what it looks like. These are all the single stocks that I have swung in and out of this year, and these are the 3 contracts that have expired, though I've added quite a few in the last 2 weeks. So I've locked in some pretty decent profits from my swings and my 3 contracts. Let's first talk about Costco and Apple, and these things are making me nervous. So in my last couple of videos, I've been talking about Apple and Costco, and I was looking at Apple the other day, and twice in the last couple of months, it's hit that 100-day moving average and bounced off. However, 2 days ago, it punched way through it. The price dropped all the way to 120. It then recovered, and it was actually green that day, but that was a scary moment, because if ever it falls through that resistance line, the moving average, there's high potential that it could continue falling way lower. So do I want to double up my position in Apple now that I'm down a significant percentage? I'm going to give it a couple more days. I want to see how this plays out. If it recovers, great. If it goes down further, then I probably will double up my position at some point. I just want to see at what point Apple starts consolidating sideways. And Apple has me nervous because of Costco. Look at this. I was waiting for Costco to go below 350 and hit that 200-day moving average, and it just punched right through it. It didn't even stop. It didn't even blink, and it's going lower now. So what is up with Costco? I'm not sure, and yeah, I think this is making me nervous. Next, a position that I added is Home Depot. You guys know exactly what Home Depot is. And there was a big sell-off today, once again, because Home Depot reported strong earnings and a dividend hike. For some reason, you just can't live up to the expectations of certain investors. As soon as earnings are reported, doesn't matter if they're good or bad, people sell off. So if you look at Home Depot, this actually is encouraging. It's been trading sideways and consolidating for 6 months, and the 200-day moving average is slowly creeping up. And with this sell-off, it punched all the way down to, what did I buy it at? I bought it at $2.56 a share. So it was $2.56. I must have bought it like right at the bottom. So I timed that perfectly. And Home Depot really isn't that overpriced. PE 22, which is good for a growing company. Price to free cash flow 23.87. I feel really happy about this position in Home Depot, and it should be an easy 5%. Okay, we're going to cover the options now, and in the event you didn't watch my last update video, I probably did a more thorough job explaining when I buy a put and when I buy a call in that video, but I know some people miss videos, so let's do a quick recap. My assumption is the stock is going up. I only want to be trading and doing contracts with uptrending positive stocks. I don't want to mess around with the ones that are bottoming out. So if you think a stock is going up, you have 3 tools available to you. You can buy the stock, you can buy a call option, which gives you the right to buy the stock later, or you can sell a put option, which you want to just expire worthless out of the money. You get to collect the premium for the contract as the contract expires worthless for the buyer. So the secret that I've discovered about trading options is you need to check the IV, the implied volatility of a contract or the stock, and if IV is high, sell a put. Because you're getting top dollar for your premium on the sale. When the IV is high, this is a good time to sell a put option. However, if IV goes down over time, you might want to buy to close it because you've already made a good profit and maybe you don't want to risk having to actually be assigned the stock. However, when IV is low, when a stock is calm and trading sideways, this is actually a good time to buy a call option because there's a good chance if you buy a contract a couple months in the future that something tumultuous might happen and the stock might jump around. If IV spikes, it's a good time to just get rid of the call contract. Doesn't matter if it's in the money yet or not. If you can capture changes in extrinsic value, so a vega change, then it's a good time to get rid of the call contract and capture extrinsic value. So let's do some examples because I know that's probably confusing if you've never bought or sold an option contract before. But let's do our first example, and I sold a put. You know I sold because it's a -1 and it says P, and this is for Meritage Homes Corporation, which is a home construction company. I think this stock, it ran up huge after the pandemic, and then it's been trading sideways. However, I think people are like, well, the home building sector did really good because everybody had to work from home, but it can't keep going up. I disagree. The fundamentals of this company are solid. PE 7.86, price to free cash flow 6.23. I'm very impressed, and I'm very encouraged that this stock has been trading sideways, which means I don't think it's going to go any lower. It can only go up if there's some kind of news event or catalyst to just trigger it going up. So this is a good stock to buy a call. I want to buy a call. However, when I checked the option chains, IV was high. A high IV number is over 40 in my opinion. A low IV number is anything under 30, and then 30 is just kind of in the middle. So I didn't want to buy a call because I thought these prices were too high. I thought, I don't know why, maybe the stock has been a little volatile lately. So instead of buying a call, I'm going to sell a put, which means that I'm willing to buy 100 shares of the stock should the price goes down. And I am. You shouldn't sell puts unless you're perfectly comfortable being assigned and having to buy the stock when it dips. So the expiration date of this put I sold is March 19th. The reason why is because theta decay will waste away the remaining amount of extrinsic value the last 30 days. Theta decay is a seller's best friend. So anytime I sell a put, it's just going to be for 30 days. I'm never going to sell a put that's farther out than 30 days. The strike price I went with was $80. Look at this. The price has not gone below 80 in the last 4 months. So if it went below 80, I'd be happy to buy it anyways. So if this contract expires in the money for the buyer, I have to buy 100 shares at $80, but I'm perfectly fine with that. And for selling this contract today or yesterday, I was paid $199.35. If Meritage Homes Corporation just goes up, I get to keep that $199.35. I don't have to buy the stock, I just get to keep the premium for the contract. Let's do a call option now that I bought, and you know I bought it because it is a positive one and it says a C. And Masco is a manufacturing company, and once again, it's a stock that's been trading sideways for a really long time. I like that. It's a well-rested stock. I don't think it's going to go down. The PE is 17.62, price to free cash flow is 19. It does have a dividend. Profit margin is 16%, pretty solid in my opinion. And the 200-day moving average has been slowly creeping up, and it just hit the stock price, which is, once again, something else I like seeing, and I think is good. I also was checking to see if they were buying back shares, and Masco has been aggressively buying back stock even during the pandemic. So the existing shares should be more valuable from this alone. And I checked the option chain, and the IV was 30 or below, or 30 for the call I was looking at. So I thought this is a perfect stock to buy a call option on. So whenever I buy a call option, it's always going to be 3 to 6 months out, and I chose one for July 16th with a strike price of 55. Now I paid money, $370.65, which means my break-even price is $58.71. So Masco Corp has to get up here by July 16th, which I think it will. However, when I buy call contracts, I want it to go up in value, and I want to get rid of it before the last month or two. Once you get down to the last month or two, once again, your extrinsic value fades away really quickly. And, you know, what's my goal with these option contracts when I buy a call? It's at least to double up. I want to make a 100% return. So if the premium value for this contract went up by 100%, then I would get back the $370 I paid plus an additional $370, which I think is possible for this stock. Next call contract I bought is Bank of America. I think you know what Bank of America is. Their PDE is 19, price to free cash flow is 487. I think with the banks, there just was a lot of apprehension that there could be another financial crisis. It's been almost a year. It doesn't look like it's happening. We've gotten 3 or 4 quarters worth of reports, and the banks are doing fine. So Bank of America had a Golden Cross event where the 50-day crossed above the 200. It's now in an uptrend, and I still think it will continue. So buying a call at this point, not a problem. Bank of America has also been buying back shares. It looks like they paused during the pandemic, but presumably they could resume as they've been buying back shares since 2016. When I went to the option chain, the IV was in the 30s, so I thought it was perfectly fine to buy a call. And I ended up buying a call for June 18th with a strike price of 37. So I paid $172 for this contract, which means my break-even price is $38.73. It's currently at $36.38. If it just gets above $38.73, I mean, this contract potentially could make me a lot of money if this upward trend just continues. Next up is the stock HPQ, and I sold a put. And HPQ is, I think, the printer division of Hewlett-Packard. I couldn't actually find it when I searched on Google, but here on FinViz, this is what their fundamentals are. PE 13.96, price to free cash flow 12.83, has a dividend, which is pretty nice. And they've been doing aggressive stock buybacks. So every quarter, it looks like they do a little bit. And what does the chart look like? Once again, they had a Golden Cross event in November, December, and it's on a clear upward trend now. So when I looked at the option chain, the IV was in the 40s, which is kind of high. So rather than buying a call, I decided to sell a put. And I ended up selling a put. Once again, when I sell a put, it's always going to be within 30 days. So the strike price is $26.50. I was paid $114 for the premium of the contract. My break-even price, where I would start, I'd be assigned the stock and I'd be down value, is $25.36. However, the strike price, $26.50, is right here. I'm basically saying in 30 days, if it's below $26.50, I would buy the dip and happily purchase 100 shares of this stock. And the last put I sold is Regions Financial Corporation, which is a regional bank in Alabama. And once again, I think the regional banks, people were staying away from them last year because, once again, they weren't sure if there'd be any kind of financial crisis due to the pandemic. However, the fundamentals look good. PE 21, price to free cash flow 9.79, dividend yield 2.79. They've also been doing stock buybacks, so I like seeing that always. And once again, a beautiful stock graph. They had their Golden Cross event in early November. It's now on a clear upward trend. When I looked at the option chains, IV was in the 40s, so rather than buying a call, I decided to sell a put. So the expiration date on the put will be March 19th, strike price of 21, and my break-even is 2016 because I was paid $84.35 for this contract. So as long as it stays above $21, the contract will expire worthless, and I just get to keep the 84 bucks. So let's recap all my positions. The first one is Costco. I hope that it just stops falling. I really don't have a game plan for Costco at this point. I'll think of something in the next week. With Walmart and CVS still looking for 5%. Johnson & Johnson, they're actually going to talk about approval for their vaccine on Friday. There will be an announcement, so hopefully that pops. With Apple, once again, I want to see it start trading sideways, and then I might double up my position. Home Depot and FMC still looking for 5%. So with the options contracts, let's just look at what I've achieved in the last week. Look at all this green. So I've entered most of these positions in the last week or two, and up 28%, up 73%, up 46%, up 72%. It's going really well. Now, with options, you know, you can gain a lot, but you can also lose a lot. So I've got to watch these very carefully because, you know, especially when buying call contracts, you can lose 100% of your investment. Whereas if you bought the stock outright, that's not what would happen. However, just so you know, with these put contracts, they all expire March 19th. And you can't just sell as many put contracts as you want. Charles Schwab is keeping track of how much I would have to pay if I were to buy 100 shares of each of these 4 companies. So I'm limited by my purchasing power on margin. Now, I'm not being charged for it with Schwab, but I do have to keep track of that. I can't just keep selling puts whenever I want. Schwab is keeping track of how much purchasing power I have left. And with the call contracts, once again, they're all 3 to 6 months out in the future. And once I get to that 1 or 2 month range, I got to make a decision. Either sell them for a profit or sell them for a loss. Additionally, anytime one of these contracts goes above 100%, I'm going to check it. Is it because of intrinsic value, price movement, or is it because of implied volatility? The stock is jumping around. If it's shot up because of IV, I might just sell the contract early. But if it's because of intrinsic value, the price movement, then I'm going to keep watching it and try and capture as much profit as I can. Okay guys, I think that's all I got for this video. It's a lot. I hope I'm not losing you. If you follow this and you like this video, give me a thumbs up so the algorithm knows it's good. In addition, don't hesitate to ask a question down below. I will help you if I can. And if you haven't subscribed, please subscribe to my channel. This is probably going to continue until I double up my money. And if I double up my money by this summer with options, then I think I'm just done. I think I don't have to do this anymore. This is kind of nerve-wracking to keep making these update videos for you guys rather than just the normal random content that I provide. So it's fun. Till the next video, take care.